Talk to me about your experience in the board of exchange. So you go in there, you go into an options pit. You don't know anything about options. You're green to this game. How did you figure that out? And for people that don't know what an option is, maybe you kind of explain what an option is.
Sure.
Because there's options in life too.
You bet.
There's optionality everywhere, and I'm guessing man has been trading some types of options with each other for hundreds of years, right?
Absolutely. There were futures and then there were options. And a future is just what the name implies, a future price of something, of a crop. You think that corn is going to be going up this year. Why? Because there's floods in the Midwest in the United States. And there were. Most of the Midwest was underwater for a good portion of April and May when the crop needs to go in. So they were planted late, which means there's going to be less corn. So if somebody wanted to speculate on that, they'd buy September corn futures, speculating that it's going to be higher in price by that time.
Right, so it's the price of corn in September
Yeah.
is what you're buying if you want to speculate it. Now, if you're a farmer or someone who has to buy the corn, say you're making bread or whatever, cornbread, you have to buy it and sell it anyways, so you
Yep.
can lock that price in.
Right.
So there's a lot of people that are interested in that futures
You
market.
bet, and that's why the government lets us do it, because it's a hedging tool. If it was just blatant speculation, they'd probably only let us do it in Vegas.
In Vegas, right. Right.
But because, you're a farmer, you're planting, 20,000 acres of corn. You're a big farmer, and you're going to make a lot per bushel, even pulling it out at $2, $2.25, $2.50 a bushel, whatever it is. You're going to make a lot of money if you get all that out of the ground. But meanwhile, you've got a big expense to put all that corn in the ground and to pay all the expenses that it takes to run that big operation. So what do? You're the seller of that futures contract because you're saying, all I want to do is lock in the contract. Now, that might sound like, oh, that's really easy. But what happens if yours is the crop that gets flooded? You've sold the future price of it, your crop is flooded, and you're only getting half as much corn out of the ground as you thought. And meanwhile, since you've sold it at $2.50 a bushel, that's now trading at $3, you're losing 50 cents a bushel, and this is a big number on 20,000 acres of corn, even though it seemed like it was just a hedge against what you had in the ground. So weather damage like floods or hail or, droughts and things like that could affect you. So those farmers, they're the ultimate gamblers. But that's why farmers make and lose fortunes some years. But as far as options, every option's for 100 shares of stock. So Apple, an example that I've used a couple times today, it's trading at $220 a share. So 100 shares of Apple is $22,000. 1,000 shares is 220,000 shares of Apple. So if you want to buy Apple, 100 shares, do you want to put up $20,000? Or do you want to buy an option, one option, that gives you coverage for 100 shares of Apple? And maybe that option is trading for $1. But since it's for 100 shares of stock, it's actually $100. So what's the better investment, Brian? Putting up $20,000 or putting up $1? $100 rather.
Yeah.
And both control that same 100 shares of stock. The difference is you've got a limited amount of time for that option, whereas you buy Apple, you own it until Apple's not there anymore,
right,
or until you sell it. So options give you a lot of leverage, and then you pick what strike price. Do I want to buy it at 220, the at the money option? That's going to be a lot more expensive than if I say, I think Apple will be 225. That'll be cheaper. That option will be much cheaper because the odds of it being 220 are very high. The odds of it being 225 are maybe 30%. The odds of it being 230 a share when it's trading 220, maybe that's only 20% chance, 1 in 5. And the computer figures all that for you.
right.
So that, in a nutshell, is options. You get to pick and decide how much leverage and how much time. And most investors lose because they don't give themselves enough time. They buy the shortest duration possible because they're cheaper.
Yeah.
At least in their mind, they're cheaper. But if you divided it out by the number of days, might actually be much cheaper to buy that option that's out there 6 months into the future. And Apple has a much better shot at going up to 230 within 6 months than it does in 1 week going up to 230.
Okay, now I studied at MIT and I learned the Black-Scholes options pricing. Okay, then I went to Bankers Trust where we had 200 quant geeks there to give me all these pricing models to price up all these different types of options with different strike prices and delta hedges. How the hell in 1981 do you learn this on your own in a pit full of a bunch of other football animals? Yeah, animals
that don't want to tell you because they want to keep it a secret too. Nobody in that pit is going to help you. So it's, again, to take it back to SEALs, it's kind of the opposite of SEALs. SEALs are made to be part of a team. Traders on the floor are not part of a team. Everybody's against everybody, and nobody's there to help you. So what I did was there were these videotapes that if you cleared through this one firm, which ultimately Goldman Sachs ended up buying, if you cleared through that firm, you could watch these videotapes. They were 1 hour videotapes, and they had like 60 of them. So you could go up there, and during my lunch break, I'd go up there and watch a half an hour of it, and then I'd watch another half hour at the end of the day after the market closed. And they were boring as hell. But you just kept doing it over and over and over again. And finally, all of a sudden the light went off, Brian. And then I got it. And I got, okay, now I understand what time decay is. The reason the option time decay is greater when there's only a week in it versus when there's 6 months in it is you've got only these 5 days for that option to do something. So that curve is like this. It's like so steep that traders on the floor would, when they were trading short-dated options, would make a sound like air escaping a balloon. Like whenever they'd sell those, that go because they know that the person that's buying that option has only a few days to be right. And they're saying, I will take that bet every day of the week. I think you're wrong. You don't have enough time, but I can't be sure that you don't know anything. So I'm going to buy some further outdated options out here that aren't going to decay very fast. They're going to decay like, not like, they're much slower decay. And then you start getting it. You start getting time decay, you start getting gamma and delta and all these other, delta and gamma and theta. Theta is the amount of time decay.
Yeah.
So that's that, all these Greek letters. For the most part, viewers, listeners don't need to be aware of these things very much. You need to know what time decay is. You don't need to know what theta is. Same thing. But if you put it into terms of Greeks, then you can just bluff people into thinking, oh, this is way too complicated. I can never get this.
Yeah. No, and I had a similar light bulb moment. I think I was telling you I was at MIT in one of the classrooms studying at 1 a.m, and it was like 1991, and my buddy and I were at the chalk, and we had the hockey stick diagram. How does this call option work? It doesn't make sense. And then bing, I finally got it. And I was like, okay, when you're long a call, you're kind of like long the stock. If it goes above the strike price, you make money. If it goes below, nothing happens. And a put is kind of the opposite, and I clicked. Yep. But it wasn't until I got to Bankers Trust and started really trading the options in a treasury option trading book where I understood time decay, because every day that we move the portfolio forward one day, like, where'd the money go? Oh, that's your time decay. Mm-hmm. So if you're long options, your money goes down. If you're short options, your money goes up. And then gamma and delta and all these things. And it really started to make sense how powerful of an instrument the option is.
Right. And the computer, having a good computer.
Yeah.
Like, you had much better computers, Brian, when you were learning options than when I was learning.
Did you have any computers in the early 80s?
It was illegal to have them in the pits in the early 80s. Okay. Illegal, even though they were just coming up with some, they called them notebooks, but they really were more like briefcases. A portable compact was like this big by this. There was no way you could bring that in the pit. And they didn't want you to, so they made it illegal. Because they said, look, if all you jerks are in here with these stupid big things, there won't be room for traders in the pit. So they didn't let you have handheld computers for quite a long time. It was into the late 80s before you could do that, because they were just too cumbersome, too large. But then when you could model anything. You could put this option against this option and know this one's time decay is going like this one's time decay is very slight. So If I have a whole bunch of these versus these, then that means as time goes by, I make a lot of money because these go away and these are still with us. So, calendar spreads, time spreads, things like that, various types of spreads from month to month. You could model all that on the computer. You could even do it in 3D eventually and figure out, okay, here's where I want to sell them and here's where I want to buy them based on the decay curves and things like that.
And so you became one of the most knowledgeable people about these instruments. And you started teaching your own people. That was something that made you different. And you really became a force. And you wanted to teach your own people so they would just understand more and make more money.
Exactly.
Hi, it's Brian Rose from London Real, and I've just sat down with Jon Najarian, legendary options trader, Hall of Famer, and TV celebrity. You might know him as host of CNBC's Halftime Report, or from his books, How I Trade Options and The 22 Rules of Investing.
I think there's just so much information in options that isn't available in stock. I think it's all about leverage and defining your risk. And if you can do those two things, I think you can be in this game a long time and make money.
Well, in just a few days, Jon will finally reveal what made him a legendary options trader. In a private broadcast that won't be available on YouTube or anywhere public, he'll show an exclusive group of people how he's been using special infrastructure that's only available to institutional investors. Something that allows him to get a critical piece of information directly from the market exchanges. Information that can tip you off about big market moves a few days before they happen.
We built this algorithm that looked for unusual trading patterns in the market. Once you find those patterns, then it makes it a lot easier to coattail on the smart money.
Now, as a former Wall Street banker myself, I am super excited to share this investment strategy for the very first time. As the host of this episode, I'm able to offer you exclusive rights to a seat at his free training. But you must act now to secure your place. So click on the link below or go to londonreal.tv/options to lock in your spot. And I will see you there.